So again, back to the zero comparison principle. I wouldn't be comparing yourself with anybody. Guys, we just get on with the job of trading. Matt, I don't believe so. I don't believe so. So guys, we also then, we're getting really, really excited about what's going to happen in 2025, but we can't lose sight, guys. We can't lose sight of the KPI chat we did in weekly coaching last week. Now, that is in the members area for you. Guys, the reason being is that we are leading into 2025. I believe somebody just said we've got 9 Fridays till Christmas. So 9 Fridays to Christmas. Does that mean 10 Fridays to New Year's Eve? I think it does. So guys, we've got, dare I say it, around about 11 to 12 weeks based on that mathematics, 11 or 12 weeks before the trading year starts again in January. Guys, and that means that we're in such a great place, guys, to not only can we gather some pretty serious momentum now, there's no question about that. Not only can we do that, guys, but we can get ready for potentially one of the biggest trading years we've ever had. Guys, we measure that in profitability only, and I think that's a very, very exciting sort of thing to measure. I think it's brilliant. Now, speaking of that, remind you if I can, guys, every day I'm putting a video out on YouTube about the highlights out of the live trading room. I mentioned as many people as I could today, guys, because we had an absolute blinder in the LTR. Guys, also, guys, the Brokers Exposed book is now out. Guys, free to download off the website. If you're just interested in a quick little read, guys, you've got anyone interested in finding out why futures traders go really, really well and everybody else generally doesn't, unless they are massive, like absolutely massive traders. Guys, generally speaking, it's covered in that book called Brokers Exposed. So that's ready to rock and roll for everybody, guys. It's free to download on the website. Now, I'm going to get rid of that, guys. We're going to bring up the charts. We're running perfectly on time, perfectly on time. Now, this is the NASDAQ, guys. This is the NASDAQ straight out of the LTR from today. Now, there's a lot of stuff we're going to talk about. This is the last trade we spoke about. Guys, it's the last trade we spoke about in the LTR, which is we're going to wait for the buyers to pinch the stair step, run into the pivot. We're going to go short and we're going to hold on to it. Now, as it turns out, have a look at what it's done. Guys, the interesting point, guys, interesting point. If you miss the LTR, guys, you see all of these strong, efficient candles and the deltas afterwards. We're going to talk about all of these as quickly as we can. Suffice to say, guys, with the delta, you may not be aware of this, guys. You may not be aware of this. But with the delta V1, V2 combination on your charts, you guys realize now, instead of picking up around about 60 high probability trades on a daily basis, so instead of 60, it's now around 320 high probability trades every 24 hours. Now, you're probably thinking about the maths going, that's a lot of trades. You need 1 or 2 to retire, guys. 1 or 2 trades to retire. And the new delta is producing around 320. Suffice to say, some people go, whoa, that's incredible. Guys, there's no rush. There's no rush. And the reason I say that, there's no such thing as I missed out on the only winning trade of the day. Now, 2 points will come out of that. Firstly, naturally, we're 5-minute chart traders. Guys, why are we 5-minute chart traders? 5-minute chart is the lowest level institutional trading chart globally, guys. So we never, ever, 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 did I say never, ever, ever, ever go lower than a 5-minute chart? Just don't. Full stop, end of story. There's no merit in doing it. Guys, a lot of people will go lower than a 5-minute chart because they want to try and reduce the risk on their trades. The problem being is that no one else that's actually trading properly is looking at a 1-minute chart or a 2 or a 3-minute chart, guys. As a result of that, you might be making trading decisions based on information that nobody else is looking at. Guys, as a result, your decision is going to be flawed, guys, because no one else is doing it. Now, that being said, come on, mate. So, guys, I've just been told that where Ahmed lives, it's the 1st of November tomorrow. So can you please have the indicators? That's absolutely brilliant. All right, so we're working on it. We're working on it. All right, now, guys, let's break down why the market did what it did today. And the really, really big lesson for everybody, guys, is the failed ABC pattern. Now, many of you don't know what an ABC pattern is. Those aren't range charts, 1-minute chart. Oh, no, Andy. Oh, dear. Is it a range chart, a 1-minute chart? Oh, no, Andy. Oh, Andy. Holy moly. I wrote an entire course on range chart trading. No. do you, in fact, guys, that's a great question. I mean, we're here to learn tonight. What is the difference between a range chart and a 1 minute chart? What is the difference between that? Andy, let me, Paul, there you go, mate. You're all over it. So, guys, a range chart, basically, every time you get a candle, let's say, for example, you're using a 10 range chart. Every time the market moves 10 ticks, it gives you a candle. It doesn't matter if that candle takes 30 seconds to form or an hour to form. Literally, you can get a 10 tick range chart candle that could take an hour to form. Whereas with a minute, so obviously a minute candle, the derivative is time, whereas with a range chart, the derivative is range. Exactly right. So, guys, I wrote an entire course on it, and in fact, ironically, that's where all the trench warfare principles come from. Guys, that's where the static bar reversals come from, of which there is a stunning static bar reversal, guys, on the nasdaq. There is a stunning one right here. There's a stunning one right there. And you know what I find really exciting about that static bar reversal, just to highlight it to the hard right edge of the screen, that delta there, okay, has triggered at the buy point of the static bar reversal. So if you are waiting to trade that static bar reversal, I mean, that's a live chart, so there's obviously nowhere to hide. If you are saying, all right, Lachie, I want these guys to sell down, sell down, sell down, I would kill for a lower low. That would be amazing. And when the buyers come in, I'm going to pick up that static bar reversal right there. And if there's a delta to enhance my decision-making process, not kidding, it's a live chart. If there is a delta right there, absolutely brilliant. I know I'm on the right side of the market. I know I'm on the right side of the market. Now, if I start getting additional deltas over the top of this, I now know I'm in for a long range trade. I say, interesting point, guys, interesting point. And in fact, you know what? We're over here now. I wasn't even going to work on this part of the chart, but because this signal's there, why don't we work on it now? Guys, interesting point. There's a lot of opinions out there in the world about risk to reward ratio. And this is what I would encourage everybody to do, full stop, end of story. All right. So we're targeting this static bar reversal. Okay. And we're targeting the delta at its confirmation point, which is that little delta right there. Now, if you had have taken that delta there, delta below is absolutely incredible, Suzanne. The delta below is incredible if you can get Fibonacci to support your decision. So, guys, Suzanne's asked the question, which is absolutely brilliant. 133, similar confirmation. Okay, mate. Okay, I'll go and have a look at that. So, Alan, thank you. Guys, now, again, subject is here. I would need a Fibonacci to support that. Okay, I would need a Fibonacci support that. Now, if I drew my Fibonacci, okay, from the low point that we had at the time back to the high point of this candle, because the buyers were basically present in that candle as much as they could. If I drew a Fibonacci up like that, I'd want to catch the bottom, whoopsie, wrong thing. I want to catch the sellers, guys, down here. I want to find out what they're failing at. Now, I think you guys can eyeball that and work out pretty quickly what they're failing at. All right, so if I drew a Fibonacci up to catch them on the way down, then what we're doing is we're ultimately looking for, a tag, guys. It's a great point, Rob. A tag of the 90%, but it looks like they're failing above the 76s. So there's our evil twins working again. So, Suzanne, if I wanted to take the lower of the two deltas, I would basically say, are the sellers failing? Yes. Are we failing at Fibonacci? Yes. All right, I'm going to turn it around and go back the other way. Now, interesting point. If you said, well, Lachie, I didn't have my Fibonacci in place, I'll take the delta at the actual static bar reversal point. Let me get rid of this off the chart. If I take the delta there, the delta is outside the range of the leading candle, guys. And this is probably one of the biggest tips I can give you on delta trading. Okay, could everybody see that delta right there is outside the range of the leading candle, even by, in fact, this here is 2 ticks. Perfect. That is absolutely hilarious, guys. That's hilarious. Now, guys, Remy, absolutely correct. Now, we were just told about a 133 fib extension. Okay, this is going to be really, really, really obvious. Let me have a look. Okay, so it's either going to be, guys, it's probably going to be this Fibonacci extension here. All right, so all I'm doing is I'm following the A and then the B. Let's have a quick look. Oh, wow. So, now, interesting point. Again, and again, well done to Alan, guys. Alan brought this up, but we know that the NASDAQ and the S&P 500 and the FDAX, guys, we know it loves to fail at the 133, 141.4 combination. So that is absolutely brilliant. It's absolutely brilliant. Now, that is what I refer to, guys, as the stair step, okay, or the ABC. You can use the dominant candle Fibonacci. So that is obviously the dominant candle. So the red one is clearly bigger than the green one. So you could, if you wanted to, guys, use a dominant candle Fibonacci extension and say, all right, where is the 133, 141.4 combination off the dominant candle? Guys, now at this point in time, guys, Alan actually wins. Guys, Alan actually wins because my little Fibonacci, I drew it down the dominant candle, drew it back up and went, you know what? These guys are not matching this correctly. So interesting point, guys, dominant candle is a relatively new teaching, probably 4 to 5 years old, guys, when it comes to Fibonacci extensions. Guys, the stair-step Fibonacci, which is from the high to the low to the high, is ultimately far more well understood globally, guys, because it's a stair-step and most people in the world can see a stair-step. So, mate, Alan, well done on that one, mate. Your Fibonacci wins. Guys, what I do find really exciting is if you had that Fibonacci on, guys, can you see that this little candle here has jumped over the top of the 141.4 extension? So it's literally jumped to it, which means that there's a crap load of it, and that's a technical trading term, right? There's a very, very large number of traders that know that 141.4 extension is there. And there's also a large number of people, guys and girls, that are waiting for the market to do what on the hour? All right, so question for everybody. What does the market normally do on the hour? It normally turns. Alan, well done. So, guys, what we've got is we've got a ratio-based static bar reversal long that's complemented by a delta, which is hilarious. Now, the question being, guys, and again, there's a lot of people out there in the world that say, "Oh, Lockie, I couldn't take that trade because the risk was too much." My tip for everybody, guys and girls, is literally this simple. Now, we do this in every webinar, and we're going to do it on every trade that I show you tonight. Right? Let's say you wanted to trade the delta long. That is your risk. Now, let's not count ticks, guys, unless the candle's out of context with the market, which it's not. Okay. What we want to do is basically say 10, 20, 30, 40, 50. Okay, say 55 ticks worth of risk. As anything under 60 when the volatility is around 60 is pretty close to normal. What we would then do is we would then throw this up, guys, as a static chart exercise. We would throw that up and we would ask the question, has the market gone beyond my 1-to-1 risk to reward target forecast before it stopped me out? You can see straight away, guys and girls, the market has gone way beyond what it's required to do. Okay, way beyond that. Now, how do we use the delta? As with the beauty of the delta, and we'll go and have a look, guys, at quite a few trades. You've got in on this particular delta here because you've got a static bar reversal over here. So a rule for the delta is very, very simple. If you're thinking of trading the market anyway and you get a delta, a lot of people are using the delta as a, yes, I've made the right decision, I'm going to take this trade. As we start getting more and more and more deltas coming in on the particular candle, you can see these deltas running in behind here. All you can do is say, all right, I'm more and more and more confident that my 1-to-1 risk to reward ratio target, in this case here, 55 or so ticks, the more I get the delta, guys, the more I can be confident that it's going to run far enough to actually pay me.